Guys, this is Anjali. So today we're gonna start with CB1 first chapter, which is key principles of finance. Yeah, let's start it. I'm gonna explain you. If you have any doubts, right now I am teaching you guys from my 10-year book. Okay, so basically I choose this first because this has like basic concepts of your full syllab of full chapter in shorts. Okay, and then I'm going to explain you the main questions, and then I'm going to go to your notebook questions, and then I'm going to go to your main exams questions. Okay, so let's start. Explain the relationship between the financial manager, a firm's operation, and a firm financial market. So they are asking you that what is the relationship between a financial manager, firm's operations, and the financial market. So let's imagine that I am the financial manager. So and there's one more person, or you can say in a firm, who is operating firms operations and all. So that manager comes to me and he'll be like, sir, we need some finance, we need money, so arrange it for us. So I'll be like, okay, I'll do it. So I'll go to the financial markets and I'll be like, you buy my shares, I'll buy my shares, and I'll give you the profits and gains and capital gains and all. So the market shares will be like, okay, we'll buy your shares. So they buy the shares and they give us the money, and that money I give to the firm's operation managers and all. So they go for the real assets purchase or your liquid assets purchase, and they run the business, and from that business we earn profit, and the profit we earn, either we give back to the financial market and we'll just be like, okay, this is your money, we are done, or we again reinvest in the financial or reinvest in the firm's operation. Correct? Good. Next question is, what are the two basic financial decisions that have to be taken? It's very easy. If you take a normal thing also, that you have to take a financial decision. So first you need to know that where what real assets we should take, or where we should invest in, like what type of real asset we should invest in. Obviously, because it's gonna be a long term investment, so you need to know that what real assets want to give you the future great deal. And second one will be your financial decisions. Easy to say that how or where, from where you're gonna get the investment, like from where we're gonna get the money to buy the real assets. So it's normal. Two decisions, basic decisions for the financial decisions. First is, yeah, second is, right, investment decisions and your financial decisions. Next, who has responsibility for taking these decisions? It's very easy. There are four people, you can say there are four people in range. First is the treasurer, who actually take care of your money of the company, and he actually raises the money also from the other sources, or you can say any sources, and he actually maintains a relationship between the firm and the he actually maintains a relationship between the firm and the other things, like shareholders, your bankers, your investors, your creditors, your suppliers. Cool? Done. Next topic. Explain why investment decisions are both difficult and important. So, as this is very easy. See, I'll take two things. First is like a very small thing, which is your working capital, but it is also important. And second one, we'll take a big one, which is called fixed capital. So, first one, capital with like working capital is basically your normal day to day working capitals, or you can say day to day we use the money and we do the business like daily work. That's called our normal working capital, which has less risk. Even we have less certainty, or we'll be like, yeah, they are not too risky to invest in, and we can take risk because they are short term and they have less investment. Second, we come last. big one, fixed assets. So basically, our fixed assets have to be very, very, very carefully chosen, because whatever we choose for our business, like a fixed asset, like I choose this against this, and if my choice goes wrong, I'm not gonna get the result in 1 year or 2 year. I'm gonna get my result that it is wrong after lots of years. So then we're gonna regret for this thing. So that's why we need to make, that is why it is very important, because it's gonna depend on your firm's growth. Means your firm's growth is gonna depend on your decision. Second, your investment. Like, obviously this is a very long term, very long term investment, so it requires a lot of money. So if your money goes down with that project, you're gonna suffer a lot. So your third, you can say, the risk is very high, and the future is very uncertain. So these are the points why it is difficult and why it is important. List three things that are achieved by financial analysts of products. What are the three things that are achieved by the financial analysis of a project? Like, what do they achieve? Like, obviously they don't achieve a lot, but yeah, they have a lot of points. Like, first point, they actually minimize the risk of the project. Yeah, by their analysis they can minimize the risk of the project. Yeah. Second, it is basically, what do they do? The next is, second point, we can say that they highlights the silent factors. Like, obviously there will be some factors which we cannot know as a normal people, but an analyst can understand and guide it. Like, yeah, you have some risk over here and you have some silent factors over here which are hidden, but I'm telling you. Okay. Now, third point is basically they're gonna give you some methods, or they're gonna tell you some methods that you can get this type of risk. So for, if you get this type of risk, so go for this method. If you get this type of risk, go for this method. So he actually tells you about the risk for earlier, on earlier stages only, and the methods how to solve them afterwards. Next, what are the two main aims of specialist financial analysts? Okay, so our first aim, or you can say the main two speciality or main aim of the specialist analyst of finance is, he should be realistic. Like, he should not just imagine that you should invest in this, or you should get money from there or something here, but he is ignoring the economic values. He is just ignoring the political conditions, crisis of the world going on, and a lot of things. So he's not being realism. And then second point is your, he should not be biased. Obviously he should not be biased. As if he'll be biased, like, I'm a financial specialist analyst, and I'll be like, this is looking good, I should go with this. But I'm not, I am just ignoring the analysis, I'm ignoring the facts, I'm ignoring everything, and I'm just following this because it's my wish. Because with this, I'm gonna get my personal benefits or my personal profits. That's why. So that's wrong. Got it? Okay, now next point is, explain how financial decision making is shared. Like, how are they being shared? So let's go for that. Okay, it's very easy, man. They're saying ultimately, okay, so they're saying, like they said, financial analyst, or like what financial decision making are shared, or with whom they are shared. So basically, main, or you can say main data or everything is required by the board of directors. Means they are the in charge, or they, you can say they are the head, who are actually, like, everything lies for them, direct. So basically they're saying that financial decisions lies with usually with the directors of the company, and the other methods like normal operational decision making are taken by the executives. But the strategic issues and the important issues are handled by the shareholders, and actually they actually appoint the board of directors. So basically the board of directors take the in charge. Next point is, what are the advantages and disadvantages of separation of ownership from control? So, what can be the advantages and what can be the disadvantages? It's very easy. Like, I'll just explain you. First point is that if there will be separation of ownership and the management, so the advantage will be freedom to choose, freedom to hire professional managers. It's an obvious thing. And like as in the board of directors can actually hire the professional managers instead, like the shareholders are taking decisions as a normal people. Or then there are unbiased structures, like no one will be having like this is my decision, or they are not gonna take the decision of whole company just by if they are getting benefit or not. They'll take the decision as a whole, as a company. So they'll not take a decision as a own own decision or own benefit. Democratic decision making, obviously there will be democratic decision making, like the if the financial manager has to take the decision, they don't have to just ask the shareholders or the board of directors that, oh, they means they have the power that they can tell, they can give their suggestions, they can give their views. Decision making is basically not it's democratic, it's not on the owner's side. Then next, what are the disadvantages? Yeah, you can say if the owners and the managers interest gets diverged, there will be lot of problems in the company. Then obviously the if you hire professionals, you have to pay a lot, so it is costly. And last, biased elections. You can say that obviously main board of directors are being elected by the shareholders, so they can do the biased elections and just elect their own members, so that the board of directors are from the shareholders and they listen to the shareholders, not to the company's benefit. Got it? Our next point. Okay. Why is there often conflict between the owners and the managers? That's a very basic question. I can just say that with this question only you can understand what would be the answer, but then also I'll explain you. Leave it on me. Okay, so conflicts are basically a very simple way you can say that if the desires of the manager and owners are separated, so they'll have a lot of fights. And it can be also the reason that the managers have different objectives, different motivations, and different, you can say different, they have different goals or aims for the company, and the shareholders have different. I'll give you an example. Like there's a project, let's say this is a project. Okay, so this project is having lots of risk, and the shareholders are like, it's having risk, but it's gonna give us a lot of profit. So the shareholders will get ready to just go for this project, but the managers have, they are not the owners, they are hired, so they have to take the decision just to secure their job, just to make the company like stable, let the company be stable, not having lots, cannot take lot of risk. So he'll be like, no, it has lot of risk, I cannot risk my job just for one project, so I'm not gonna take a decision for this project. So that can be the conflict in the between the managers and the owners. Okay, and our next topic is list six other stakeholders between whom conflicts may arise. That's very easy. I'll tell you the stakeholders, and then I'm gonna explain you what conflicts can be there. Political parties, political parties, environmental, environmental list. Okay, political parties, environmentalist, shareholders, managers, consumers, financiers, suppliers. There are 7 points. I'm gonna explain you one by one. Political parties. Like I'll just say that I was uh, I was with the BJP and all the company. My company was for following, or you can say was good with the BJP, and suddenly Aam Aadmi Party came, so they changed a lot of rules and all for the company also, which is gonna make me suffer a lot because my company was going great with the old policies and old rules and regulations. Now it's gonna suffer. So first false, or you can say first conflict. Second, environmentalist. It's an obvious if I'm just gonna start with a new factory opening. So if I'm gonna, obviously I need to establish it, and it's gonna provide it, it's gonna produce some bad, you can say, pollution and all. So it's gonna make the environmentalist very anger, and that person will be like, no, 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 you cannot open a factory over here. So there can be conflict over there. Then shareholders, it can be reason that shareholders don't want us to invest in this project, or it can be like this also, that they don't want to they are like, they want us to go for a higher risk project, and we are like, no, 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 we cannot take too much risk, so that's why we're gonna take this project. Managers, decision making and lot of things where higher risk is not involved, so the managers can have the conflict with the company's decisions by taking this or thinking this, that or you can say that if um, we are not appreciating their work and all, for no, not that point. Consumers, yeah, consumers can think that like, as in, if consumers didn't like the project and they are not understanding or getting the project results, so they're gonna just get off with the company. Like if I'll just say of a product, like yeah, let's say that there is a project called, let's call it this, but I am not used to it, so I don't know the use of it, I don't know what is it, so I don't use it so much, so that's why this is waste for me, so I'm not gonna buy it more, or I'm not gonna, I'll be like, why you are selling this product or something like that. So the consumers can just back off with that company. Financiers, yeah, they'll be like, don't go for the higher risk projects because it's gonna risk their money, because it's an obvious thing, shareholders can take the risk but financiers cannot take the risk, because they are not too much for like they are spending their money in a company for the profit, not for the loss. Suppliers are basically that if they want to, if they can allow for the more credit purchase, and if they can just think, okay, they don't get a supplier good, or if they don't get the, there are a lot of conflicts between the suppliers and the firm. Next, describe the fundamental conflict between the providers of finance. Like what can be the problems by the financial providers. So first of all, we need to know who are the finance providers. As we know, bankers, bondholders, shareholders, and your financiers. So, like, as in, it can be possible that the lenders, the financiers, will go for the they have short term desires, and they are mainly for the security. They are not for the higher profit, higher risk. So that's why they're gonna support the profits, or they're going to support the investments in less risk projects. And on the other hand, shareholders are for the long term interest. So that's why they're going to, like, they can take the risk for like they can take risks. So that's why they're going to go for the higher risk investment or for the development of the company. So that's why that's a term called for the conflicts and the cost for them. Next, what are the two sources of the cost? Okay, so they are asking you that what are the two sources of cost? Like, why do we do the costing and all? Why do we need cost for them? So, first is monitoring the actions of others, or you can say monitoring the actions of the managers or your agents. Second, seeking to influence their actions. Yeah, you need to just influence them. You need to just take care that they do it properly. They are like focused. They are like strict to your aim, not to their own aims. And yeah, done. 2 points they said we are done. Explain the role of information and agreements in reducing conflict within an organization. Oh, that's a good question. Like, what is the role of information which actually helps us, or agreements which actually helps us to reduce the conflicts between them? It's a very good question, and with that, I'll tell you how. Like, if you share the same insights into the future, like, as in, if you just tell, like, as in, if all the parties, like, that's first, you can say, that's a first assumption that all parties should have one insight that yes, we should focus on the company's future, not our own focus, not our own future. Sorry. Okay. So next, so the obviously the information will get failure between different classes of stakeholders. Like, we cannot share all type of informations to all type of stakeholders. It's a different thing. Like, I'll tell you why. Because um like, written agreements between everyone, like, there are written documents, but you cannot mention everything or every future certainty in that agreement. So it's not possible. So the agreements, or you can say, they are less formal, and they should be like understanding between the stakeholders. It should not be like, as in, everything should be, you didn't write this thing in your agreement and this happened. So it's stupidity. You cannot just blame everyone for the agreements. That's a second thing. Like, first thing was like, that no, everything we cannot share in the agreement, and second was, we cannot be certain about the futures in our agreement. Next topic: how is a firm seen from a viewpoint of contractual theory? This is a very good question. Contractual theory. So, contractual theory says that network of contracts, actual and implicit, which specify the roles of the various participants in the organization. Okay, so we're gonna go for our next topic, which is contractual theory. So, it's a very good topic. So, basically, it views a firm as like, you have a lot of networks of contracts, like actual and implicit. Like we make the actual and we need to see that what it gonna give us, so with some specific rules in it, and with like various participants in it, for example workers, managers, owners, lenders, etc. And obviously we need to define the rights, obligations, then your payoffs with various conditions, everything in that contract. Okay, so some participants can bargain for limited risk and fixed payoff, but the owners are like residual risk. Like they go for the residual risk. They can go for key. Okay, we are ready for taking more risk or unlimited risk, and it's an obvious that we'll not be able to get fixed payoff. So that's called contractual theory. Next topic is, give two examples to illustrate how a firm can show its concern for its stakeholders through its contracts and its policies. Oh, so it's very easy, like as in what can we do that we can just assure the like as in our debtors, that or we can assure the debt holders that like we can say that we don't give strong assurance to the debt holders, and that like if I am investing, I'll just tell you. Okay, so for next question, let's take an example. Like I'm the owner, and or I am the share. Okay, for the next question, let's go for it. So first, like I'm gonna explain you with an example. Like let's say like I'm gonna invest, or my company is gonna invest in a fixed asset which gonna change the policies and which gonna make more riskier, and it can be possible that for in further we gonna get risk and we gonna get less profits. So our, you can say our creditors, like all the members or lenders, will be very insecure and will not be able to pay us, will not pay us, or something like that. Just for a reason, they'll be like, oh, this gonna give us risk. So for that we actually change do the changes in the policies, or we actually increase their interest rate, so that they get the compensation over there, that they're giving us more interest. If then also if they have risk also, then also they're paying off a good thing, so we can handle it. So yeah, and then we actually do assure that yeah, you're not gonna get dumped by us. Okay, next, what are the implications for the firm's overall objective of the competing demands on firms by its stakeholders? Okay, let's do it. Okay, in this question, there's one more point which says externalities. Like as in, if I am into investing into new fixed project or fixed assets or anything, so we need to actually take care of the pollution and safety products and job securities for this, so that like we need to make some policies for these things, so that the external groups or our stakeholders, external stakeholders, don't get angry from us. Okay, let's go for the next question, which says, what are the implications for the firm's overall objectives of the competing demands on firms by its stakeholders? Okay, so basically it is like we, the industries and the government, should cooperate in establishing rules for the cooperative behavior, so that firms strive to maximum shareholder wealth within external constraints. Like it's I'm going to explain you with normal thing, like what implications that the firm overall objective competing demands on firms by its stakeholder, like as in what do they see as a implication or see as a problem. So basically, like as in we make cooperative decisions or rules which actually have one thing, that to maximize the shareholders' profit. We are just for their making their wealth more. Okay, our next question. Assuming that managers and directors aim to satisfy the objectives of the shareholders, explain why and when one considers the various needs and objectives of shareholders, this might be considered difficult to achieve. And second question, why in practice it results in a single goal for the financial manager. See, these two questions are very easy. It's directly saying that what are their aims or something like that. Okay, so let's go for the first question. What do we need? Like, needs of shareholders. First, towards, like, as in every shareholder are different. Like, there are lots of shareholders of a company, not a one. So we actually classify into their needs. First is like how is the attitude towards the risk, like how much risk they can take. Like if I'm a small shareholder and I am just investing less, so I'll can't take more risk, or I'll be like, no, I cannot take much risk, so I need less risk. There are different type. Then time preference, yeah, like as in I'll be like, no, for 1 year, no, for 10 year, no, for 5 year. Consumption needs, like as in how much they consume or how much they can invest or like that. Balance between the needs of our income and for the growth, capital growth, yeah. They need, like some people go for like how much they're gonna have the income and how much they're gonna, like as in go for the capital growth. Like it's basically what is their need more, like income or growth. It depends on them that how they balance. It can be like this, it can be like this, it can be like this, anything. Tax position, obviously how much tax are they paying, by which they can just actually enjoy or not enjoy. It depends, yeah. Okay, so basically our next question goes like, what was it, why they have a single goal, like the financial managers have a single goal? Because actually this is solved by the market. Like actually the market is basically, they provide, the market providers free competitive capital market exists. So basically it provides us the information about everything, and like shareholder can choose where to invest, where to meet, where their profits or their needs are meeting the most, and where the risk and everything is less, and also on. So, as in let's assume that every shareholder is rich. So, if the managers, simple, like you can say what it is, what would be the manager's aim? Because shareholders gonna seek for maximum, like how they can maximize their current wealth. That would be their aim. So, what would be the financial manager's aim? To increase the market value of their shares, obviously. So that is why you can say simply, by all this scenario, that the financial manager's main aim is to just increase the market value of their company. Next topic. Next we are with, if the overall goal of the financial manager is to maximize the market value of the shares, explain the criterion the financial manager should use to make investment decisions. Like, that's a very good question. Okay, I just got with this. Like, it's like, that's a very good question. Um, Next class. Okay, so you can say that they actually tell us, or you can say that they actually make the criteria of financial decision by, or you can say through the pattern of future cash flow. Like, what is the pattern of the cash flow? Like, is it positive or is it negative? I'll tell you with an example. Let's say that this is a project, and I said that this is gonna cost me 1 lakh after 10 years. So I'm going to discount this to the present value with the rate of interest and net present value and everything. And then I'm going to see that if it's coming positive, so this going to add my value to the shareholders' wealth. And if it's going to be negative, so that's going to destroy, or that should be avoided. So that's going to destroy my actually the share value of the shares. So that's the criteria for making decision. Next topic. What rate of return should be used to evaluate rate in investment opportunity? Okay, let's see. So let's say if the market is like able to identify what cost of capital is there, or what decision, like if they make the decision for the cost of capital, then the rate of return on investment is like the rate foregone by investing the project rather than investing in securities. So it says that the rate of return will actually be more with the rate, like as in what investment project should, like as in rate of interest for the investment of the project, not investing in the securities. Like if I say that alternative in the capital market, that is, I'll just whew, erase it. Okay, so for the rate of return, basically, first the market will help us to analyze what cost of capital we should use, or what we should take a decision for the cost of capital. Then we are gonna just actually, like, see, this is the market or this is the investment. So we'll take more preference to the investment projects, and we're gonna go for the rate of return as per the investment project, not as per the whatever we say for the securities. Okay, so basically our rate of return will be more into foregoing of the investment of the project. And also we're gonna see that what conditions of rate of return is gonna offer us, like alternative methods, or we need to take out the risk, how much risk is associated with the project, and how much rate of return or returns that it gonna provide us. Like we're gonna compare it, and then we're gonna decide what rate of return we should actually take. Then, what alternative equivalent investment should be used to guide the financial manager's decision? Okay, so basically, they are saying that we take the point of view of the shareholders, okay, like for the alternatives and all, so that rather than like as asking, rather than simply asking whether the return on the project is greater than the cost of borrowing the funds needed to finance it. Okay, like actually they're saying that basically they're saying that what like as an alternative equivalent alternative equivalent investment should be used, like what they should use. So they should actually take the opportunity to, like as in, go for the shareholders benefit or make them happy, because they're gonna provide us, they're gonna put the capital in our company, they're gonna help us more as compared to like the borrowing funds and all. Because we actually not gonna just go for the return of the project is greater or cost of borrowing is more or that. So basically we'll go for the capital. Next, why is it not appropriate for the financial manager to use the cost of borrowing to evaluate investment decisions? This is related to the same thing. So basically, it's gonna increase the value of the company, because if we borrow or we lend money, so it's not gonna, like, as in, like, I'll tell you how. Like, there are two companies. One is this and one is this. So this gonna borrow money from the banks and lenders, and this gonna just go for the shareholders and gonna just invest from the shareholders. So the value can go higher for this. The company's value will go higher, but it's not gonna maximize the value in the shareholders or in the market, in the share capital or share market. So the value will be more over here, because they have to give more to these lenders. They have lots of, you can say, credits in their pockets. So that's why. Then next, how does the capital market monitor the performance of a firm? Just how do they actually monitor the performance of the firm? So basically, with this, we can say the stock market helps us in just monitoring the performance, as in, if they are going perfect or everything, so they're gonna go higher. And actually, I'll just tell you with an example that share price and the market perception of the firm's current and expected future performance. So not performing effective, yeah. So I'll tell you with, okay. So for the capital market, like how it is monitored, basically with the help of share market. So I'll tell you how. Like, this is my company and this is my manager. So my company is gonna get the result of his work with the help of the market. Like, if the company shares gonna raise the price, like their price goes raise, so he'll be happy. He Yes, you did good job, good work, good work, good work. And if the prices go down, so he hasn't worked efficiently, he's not a good work, or it can be possible the company can be takeovered by someone. Next, how does the capital market affect the performance of the firm? Okay. Okay, so basically, the capital market continuous assessment and everything. So it's gonna tell you the efficiency and provides incentives to the business managers to improve. Like, we can say that how they are asking you that how the like how can you just improve the performance. So basically, you can just motivate the managers, you can give them incentives, you can actually, you can actually change them, so that some motivated people come and just go for the betterment of your business. Okay, last question is of this chapter. Give four examples of decision taken by a firm that are affected by the capital market. Okay, so first point is, they actually are accurate measurement. Like, they have, with this investment decision, they can actually go for the accurate measurements of the cost of the capital, like it affect the capital, like by the capital market. Then, okay, limitation in the supply of capital focuses on the, yeah, obviously, there if there will be less supply of the capital, so they go for the other methods like lending. They go for the lending. Then it can be like for the other companies, our company can be the threat and opportunity to go for the mergers and the takeovers. Then externalities, like obviously they actually can require managers to determine the appropriate role of the company. So basically our externals can be like as in very interested in our companies, knowing our company's role. So like if they can like they want to know that if our company is going for good thing or bad thing, or if they are investing in, they are working environmentalistly or not. So guys, from the chapter we have discussed the finance and the real resources, then finance and the organization's objectives, responsibilities for financial decisions, then the importance of capital budgeting, financial analysis, then our stakeholders, then we have completed conflicting objectives of different stakeholders. We have completed contractual theory. We have completed the capital markets and the maximization of shareholders' wealth. Then we have completed the theory of maximization of shareholders' wealth, agency theory, in role of informations, role of agreement, and our social responsibilities. True. Okay. We have also completed the goal of the financial managers, the opportunity of cost. Okay, so first thing we need to cover from our book, which we'll not get in our tenure because our tenure is little old. So yeah, that is EVA, that is economic value added. We have read this question in one of our question, but we have not cleared it fully, so I'm going to explain you again. So it is basically to know the evaluate the ability of the managers, so what they are adding to the firm. So, for evaluating the management performance, we actually compare the operating profits with, like, we adjust the taxes and all, and then we compare it to the firm's total cost of the capital, including the cost of the equity also. So if it is giving us the positive result of positive EVA, so it is actually adding to our firm, and if it's giving a negative, so it is actually declining the firm's value. Okay, our next topic is regulating financial reporting. So actually what does financial report mean? So it is basically the accounts which provide information to the business, like how they are profiting, how they are going for the profitable, how they are valuing the assets and liabilities, how much cash do they have, how management plans are going on, and etc. So this is basically known as the financial reports, and this is like we actually get to know from the financial reports. So their main aim is to just like as in so that all the parties together can make decisions with the help of the financial reports, the informations they have. They'll get to know about the financial performance and the firm's performance and the financial position of the firm. Yeah, so they have two important bodies, like for the accounting regulatory frameworks. So first is your IASB, which is your the International Accounting Standard Board, and the second is Financial Reporting Council. Okay, so we're gonna just discuss the IASB in short. Okay, so what it is basically, it actually sets the higher like high quality global standards for the firm, in which they have to actually their main objective is to like as in make a smooth standard for the international accounting. And then our FRC, that means like they actually ensures us to make they ensures us to have a high standard of reporting and auditing to promote promote investors confidence, like if they'll be having a good auditing, so the investors will be motivated. Okay. And also they actually they allow the market to operate efficient and to just go for the economic growth. And we're gonna read these things in our corporate governance and organization. So FRC, we're gonna understand it clearly. So it is basically the UK cooperative governance and Scottish codes and UK standards for accounting, for auditing, and actuarial work. So, what is government corporate governance? It is basically the system by which companies are directed and controlled. So, it is basically like for the for the companies, it's like a system that how they have to direct, how they have to work, how they have to control everything. So basically, what do they do, or what's their responsibility? So basically, they give us the control in a company, in which the board of directors have the responsibility to govern the company, like to just let the company follow the to make them to make their company follow the rules and regulations and everything. Shareholders role is to appoint the directors, then appoint the auditors, and then to just make full governance structure and all everything. And the board's responsibility is to maximize the to make the company's strategies and all, to provide leadership, to supervise the management, to report the shareholders about their profit, ownership, and everything. And board's action is to like for the like as in to make the company follow rules, regulations, and make the shareholders come for the meeting. And that's it. So these are the main. Now we're going to talk about the UK corporate governance code. So there are main principles of codes. There are five: leadership, effectiveness, accountability, remuneration, and relationship with shareholders. Now first is leadership. So what is leadership and why it is important? So basically it helps the company for the effective governance and all. And like as in they help, they actually, these are the codes for the boards to just follow the you can follow these, you have to follow these codes, but you can just make some changes yourself. But the principles or the codes should be there. So their main aim is to maximize the governance like effectively, and for to work or to is their responsibility is to go for the long term success of the company, not for the short term. Okay. So they the principle or the code tells us that there are different responsibilities for the board and for the executives. Like no one person can go for the board and executive both work. Okay, so this is the principle. This is important. Then there is a point which says that this principle helps us in making the strategies for the company, uh, giving the value for the company, standards making, then risk management, and everything. Okay, now next topic is effectiveness. So it actually aims the board to just make a balance between the skills, experience, independency, and knowledge of the company, which help them to like achieve or discharge the respective duties and responsibility effectively. It's very common or simple way. And the principal needs, like they need to set up these things importantly, like appointment and training for the new directors. Then timely provisions of information about the board, like if they are like they have to tell to the shareholders that we are doing this and that and all. So directors actually allocate the duties, like as in they actually give time, they should give time for their duties and all. then evaluating the board's performance, that how they are performing, how they are showing their performance, like if it is good or not. And actually re-elections, like we cannot, the boards cannot just go for the years and all years without changing, because then it will be like, moreover it will be like they'll be thinking, their thinking will be different, or their thinking will be very casual. So we need elections time to time, so that new thinkers and motivated people come, and can the company can grow more. Accountability. So accountability is basically that board should be fair, balanced, and understandable, like for the company's position and the prospects, like what are their prospects and all of the company, and what position are they establishing. So board should clear these things. Also, they should be little formal and transparent agreements with their stakeholders, so that they can ensure reporting and risk management and internal control over the principles. Then also, they should tell the risk involved in the aims or achieving the aims, or like they should maintain the sound risk management system, so that they should actually tell the shareholders that these risks gonna come soon, we're gonna like face these risks sooner to achieve our aim. Remuneration. So basically remuneration means like we need to be transparent and formal, and we should be like as having basically we should actually go for the paid things for the executive directors. And it should not involve like like as in they should not take their own decision of like remuneration, that oh, I should get this much paid or something like that. Individual direct should like like they should not take their own decision for remunerating individual directors. They should have some thing like associated, that this work is associated with this, or executive should be paid by different things, or some changes should be there, whatever the government or whatever the company decides, that should be paid off. Relations with the shareholders. So basically, it is the board's responsibility to satisfy the shareholders and encourage them to participate in the general meeting, and to solve the problems they're going to face, and to make their to gain their confidence. That's it. Okay, there are some questions, practice questions. So what I'm gonna do, I'm gonna complete this chapter after, like with these four questions, and uh, for the assignment and 10-year questions, I'm gonna go after my third chapter complete, because it has a booklet which has all the three chapters mixed. So first, let's complete first three chapters, and then we're gonna go for our tenure and our assignments. Okay. So, which of the following situation is least likely to give rise to agency cost? So, first is a car manufacturing business which employs managers to carry out day-to-day operations. Then second is an oil refining business in which the government takes a great interest. Third, wages negotiation in which managers have more information than unions. Fourth, a retailing business which has one owner manager. So I'll not tell you the answer right now. I'm gonna just explain you each point and why it is having agency cost, like why they have more agency cost thing. I'll tell you how. First is a car manufacturing business which employs managers to carry out day-to-day operations. So they are actually employing managers, so they are actually going for agency cost. Okay, because they are going to incur law and they are going to incur cost for the agency, and there will be the relation between the principal and agent theory. Second, an oil refining business in which the government takes the great interest. So yeah, there will be the owner and the manager, or you can the stakeholders conflicts. So yeah, there will be some agency cost, so that the business does not like is taken over by some government. Then wage and negotiation, in which managers have more information than union. Yeah, there are union also, and there is owner, there is union and manager, so there will be conflicts. So there will be agency cost. A retailing business which has one owner manager. So I guess D, because D is like the owner and the manager is one. So there will be no conflicts. That's why. Okay, which of the following is not one of the heading in the UK corporate governance code? So this is a good question and we just did it, so we can answer it. Leadership, profitability, accountability, and remuneration. Which one? Profitability. We haven't studied this profitability in it, and no code says that there should be profitability. Like no one gives a assurance, or no one gives a code that you should always come up with the profits. That's why. Describe the role of financial manager. We have done this, and I'm gonna tell you that how many questions we did for this thing. So basically, first we did for the like as in financial manager, or link between the firm's operation and the financial market, and then the main two decision taken by the financial manager, and then why they have important and difficult decisions. Then we did it in that also, that um yeah, these are enough. So you can actually write a great lecture about it. So now next question. How explain how businesses are subjected to the discipline of the capital market. It's an obvious thing that without capital market, a business cannot be like as in very effective, or will not go for a very good run, because they'll get to know daily or in some time that what is their position in market. So that gonna help, and we have studied this too in our questions. So yeah, basically we're gonna just actually market continuously tell us that what future, what we expected and what we now have, and how is our performance going on, how is the value of the firm's shares going on. And this gonna help us if it's going for the poor thing, so we're gonna just pull up the ears of the managers that why it's going so low. We can get to know that what performance the managers are having and what they are doing. So also it can help us to just get a warning that our company can go for the acquirance and like as in takeover and all. And it can help to, we can just actually change the manager or something, or we can just actually take some other decisions, or take some other, we can actually incentivize the manager so that they can perform better. So that's why we get to know that yeah, our business is working hard. Okay, we are done with our first chapter. We'll see you tomorrow. Bye bye, guys.